Hey, everybody. Welcome to the Multifamily Legacy Podcast. I'm your host, Corey Peterson. What a beautiful day it is, and I'm excited to bring a little bit of magic with a great guest, and we're going to talk about how to be the lender and not the borrower, how to make some money, using your capital as notes, doing notes. And so our guest is going to be, I think he's going to give a lot of valuable information that I think you're going to love, and excited to share it with you. Before we start, though, I want to really jump on to the people that go to iTunes and give me a 5-star review. Here's a new one. Super excited, but it's come from CMU Stud 23. It says, Corey provides massive value. If you're even considering getting into apartments, I'd highly recommend listening to Corey's show. He is no fluff with great content. Listen, I love it. I absolutely love it when you guys take the time to go to iTunes and leave a review. If you've not left a review, tell yourself right now that you're going to go do it, and then just commit to it and do it. I love reading these things, so it's super, super exciting for me. Also, if you'd love to learn how to get involved with Kahuna Investments in my company and potentially maybe become one of our investors, then I highly recommend that you go to kahunainvestments.com, kahunainvestments.com, and click join, get into the deal room button. It starts a process so we can establish a pre-existing substantive relationship with you, and so you can eventually be able to look at our new deals. Now, with that said, super excited to bring you a kind of a little different flavor on raising money and using it for a little different than multifamily, but I still think it's of great value. So my next guest is Jim, and I'm gonna murder his last name, Maffuccio. I think I got that right, but he's been in real estate for over 30 years. He's lost everything twice, and he has found the way of making really good money in real estate, and really he learned it from getting hit from lenders, and so now he just decided to become a lender. So he helps investors earn high yields without the volatility of the stock market. So if you guys would put your hands together and help me welcome Jim. Hey, James, welcome to the show, brother. How you doing?
Great, Corey. It's good to be here with you on Zoom today.
Yeah. Before we started the show, and we were just kind of talking about, what you do, and you said something that I thought was just, it's the name of the title for this show, which is Be the Lender, Not the Borrower. That's such a profound statement, and I would love for you to share to our audience what that means and kind of your guys' journey and story of how you, by being massively in debt, you're going to make lots of money.
Yeah. That's what I like to tell people at conferences we go and speak at occasionally. It's like, for the first time, I'm up to my ears in debt and loving it, and the reason that matters a lot to me is I've been washed out twice by being on the wrong side of the debt equation as a developer, small developer in a large pond out in Southern California. And, I was an engineer prior to getting involved in real estate, civil engineer, project management background. But then I got involved in 1986, very beginning. I jumped out of the corporate world, and I haven't gotten a paycheck from anybody since that point in time. So 30 some years here. But, being a developer, using mostly private money, you don't have the staying power. And when we go through the kind of cycles that we do, especially in the coastal markets, man, debt is not your friend because it just eats you up. And so I got chewed up and spit out twice, and having amassed a pretty good net worth both times, and then to be zeroed out, find myself, in my 50s with 5 teenagers and 0 sources of income. And I had nothing but my real estate experience. So I went on a search, like, how can I get back in the game? And, I kind of had an epiphany in 2010, and it was like, you might want to look at what's been destroying you.
What's been taking you out, right? Yeah.
Yeah. It's financing. And like, it's become kind of cliche now, but, when you drive into a city, you don't see, the names of rehabbers or flippers or even that many builders on the tops of buildings. You see banks. So kind of an aha moment, like, hey, I wonder if there's a way to be what those guys do, because not only are banks too big to fail, even the little ones don't, so of course
right. Even the little ones don't.
Yeah. So there's room. So I started going to conferences and really just kind of reinvented myself and started talking to people that buy the whole world of buying distressed debt. And, back in 2010, it was everywhere. Banks were hemorrhaging. They just, they called them toxic assets. And, truly one man's trash is another man's treasure. So I went to a conference in 2010 in Denver, and I heard a bunch of guys, and they were all talking about buying first liens. And, essentially you can gain control of a property for, maybe in the 40 to 50% of the value of the property. And then you have the work of, figuring out whether you're going to take the property or try to work with the borrower. Well, off in the side room, there was a guy talking about buying second liens. And most people are like, are you insane? You're buying defaulted second liens post-mortgage crisis. But then I heard the price points that you could buy these at. And then I got thinking, if I could buy a defaulted junior lien where the senior lien is still performing, it's like, wait a second, I got somebody in the house. I know they have a job because they're paying their first mortgage. I know they want to stay, and I can buy this second at a fraction of what's owed. And it's like having a call option on the equity in that property that never expires and only gets more valuable.
Yeah.
So I bought my first, and I was broke. I mean, I was flat out broke. And I pulled a few new friends together and raised a little bit of money, bought a handful of these loans in 2011. And because on paper it looked great. And then I realized, wow, this is really working. And I started getting some payoffs. And I met with the guy who's now my business partner in 2012. And he had at one point, he had the fastest growing tech company in the Midwest, and he won the Ernst & Young Entrepreneur of the Year award. And I knew this guy. We were sort of friends, didn't know him that well. And we had coffee one day, and he says, tell me what it is you do, And I said, well, I buy defaulted HELOCs and junior liens. And he goes, you're insane, man. This meeting's over. And I said, give me 5 minutes to explain to you why it's good. And after 5 minutes, he was like, man, here's my IRA. Go buy some more. And then after about 4 months, he said, the heck with further beta testing. I want to do this with you. So we started Aspen Funds in 2012, and now we're more than 50 million assets under management. And that's cost basis assets. That's really a whole lot more real estate that's controlling. And so we've just been scaling the business and hiring people. We've built a workout team that most of them are on the East Coast. They're former bankers. We're super compliance minded. We're licensed. We started the process of getting licensed as debt collectors and even as mortgage lenders across the country. And then finally, we just got taken under wing by a national bank that is now the trustee for all of our funds. And so we, when we vest our loans, they're vested in the name of this bank. And so we kind of piggyback on their nationwide licensing. So we went from being an opportunistic player, very entrepreneurial, to we're sort of a perennial player in the space now. And we're just doing nothing but growing. We've just had our 2 best quarters ever right through COVID. I mean, it's been a huge blessing, but we've built a great team and some good systems. And so now we just open up our funds to private investors. We just got a $10 million commitment from a institutional investor that's going to be a senior debt facility. And so, we go out and we buy boatloads of these loans and then we work them out. And we really try to create win-win situations. The best case scenario, and it happens about 70% of the time, is we're able to keep a homeowner in their home with an adjusted payment structure, oftentimes reducing quite a bit of the principal. And so they're back in an equity position in the property.
Now it becomes performing instead of non-performing.
Yeah, and in the meantime, we're making we're giving our investors a really nice return. Like I've mentioned to you off the air there, that we're making about 2.2 to 2.5x on everything we buy. So if I buy $1 million worth of these non-performing loans, I'm going to generate $2.5 million revenue, and it can take to get through a portfolio, it takes anywhere from, you start getting some returns at 6 months, but typically in 3 years, we're out of those loans. And so you just mentioned, we create reperforming. So we're rehabbing the paper instead of the property.
Right.
So we create reperforming loans, and then we realize we're selling those
you can sell those notes to another buyer that will pay more for them.
Yeah, and we realize we're selling them at a discount. Like let's say we buy, and these are real numbers. We buy at an average of 18% of the payoff balance that's owed to us.
Right.
Well, then we turn around and sell the reperforming loan. It ends up being about 60 to 70% of the payoff balance, so that cash flow investor is getting the yield they want. Well, we started realizing, shoot, these people are going to be wanting to refinance and pay off this higher interest debt. Guess what happens when they pay it off? They pay off the 100%. And so that buyer of that reperforming loan not only gets a good yield while it's cash flowing, but then they get a windfall when it pays off. So bottom line is, about 5 years ago, we started as the other wing of our business, the income side, and we actually buy reperforming.
Keep them the whole cycle, right?
Yeah.
Get them to performing, buy the performing, keep the performing in another entity, but that's what it's your long-term play.
You got it. So that's the passive cash flow side, and we buy loans from many different sources on our income side.
Not just from your guys's.
We can't generate enough. We can't generate enough product for that, because the investment world is very, as you know, very yield starved right now and cash flow hungry, and so. Honestly, it's good to be us right now, just like it's good to be you, and you're in the multifamily space, and that's a phenomenal world too. So.
Well, and we're coming through the next cycle of stuff. I mean, I think the market's going to open up for everybody, even for you. There's going to be a lot more non-performing type of things out there to go find, just because of what we're in with COVID, and as an investor, I'm actually very excited about the future, what's coming on, right?
Yeah, it takes some guts to say that. And I know you don't take lightly that, like I don't, that people's livelihoods are being trashed and their businesses. And it's really sad. It's kind of like, people are asking me like, well, how's this, what effect is this having on you? Yeah, we have some people that have asked for forbearance that we're of course working with. We haven't seen really a big disruption in our cash flow, which is kind of stunning to me. But, it's kind of like asking the undertaker, after a tsunami, like, well, hey, how's business?
Right.
Yeah. I mean, you don't want to say business is great because it means people are dying. But, honestly, there's going to be a lot of debt. And I look at it like this, Corey, somebody's going to own that paper. And because of our value system, we're probably going to be their best creditor.
Well, and that's it. That you're going to be the best ones to maybe try to find, because you're buying the paper from other banks or whatever it is. They're the ones selling it at a discount.
Yeah.
And so
they can't do what we'll do. They wouldn't do, and they can't do, because we're entrepreneurial. We roll our sleeves up and work it out.
And say, how do we make the workout? How do we get this back to performing?
You may
need some time, whatever. And you've got the patience to turn it around. Exactly. and try to get as much of that to performing as possible.
Right.
You
got it, man.
And really, and then the other part of that is having capital ready to deploy. Right. So that's something that we very share in the common. Even though notes and junior liens, all that is a little bit different tranche of real estate. Capital always seems to be the same in one way, shape, or another. So you've talked about, I'd love to learn about some of your capital structures of how you went out and raised money for these types of ventures.
Right. So the first, again, going back to the very beginning, I got a handful of friends together and I put together a simple joint venture agreement, and, because I had to do what I had to do.
Yep.
Then when I hooked up with my partner, we said, hey, let's do this. Let's use a Reg D, Regulation D, 506. Our first funds are 506B, which doesn't box out people that aren't accredited investors. We call it, it's called in the industry a family and friends fund.
Yep.
So
that's
we
what we
raised our
do.
first.
That's what I teach. Most of our funds that
Yeah.
we've ever done are 506Bs.
Yeah, it's a great place to start. And sometimes people, depending on your network, you never have to leave that space. But so we did a 506B, just went out and raised like $1.6 million. And then I was the workout guy. We worked through licensed servicers. I went out, bought the loans, contacted the borrowers, did all of it except for the actual servicing of the loans. And so once we realized this thing's a going deal, then we started forming. And the format we're using now is we do serial funds, which means one after another, and they overlap. And the reason for that is, and by the way, we're using 506Cs mostly now for that, and that's accredited investors only.
Yep.
So our feeling is the deal flow is very lumpy in our space. You can't go to the local, even as compared to senior liens, they're just not the junior liens are not as available. It's hard to find them. It's all relationship driven. We work with other larger hedge funds, some institutions, some intermediaries, and we've built some relationships which keep us, in deals, but it's lumpy. I mean, we might get a $5 million purchase and like, oh my goodness, let's go raise the money. So what we decided was to do these, serial funds where we have a raise period, we have a deployment period, and we have a harvesting period. And then we overlap those so that we're always raising, we're always deploying, we're always working out loans. And it's worked out. It's like a chicken and egg game continually. It's the same thing whenever you're raising money to do deals. But it's very non-steady state. But that kind of helped us get that helped us even out the curve.
And with the 506C, you now have the benefit of you can market and advertise for that.
Yeah, and that's all starting to kick in now, because when you have a 7 or 8 year track record of success, and we're very confident now the kind of returns we're going to be able to generate. So now we've attracted some institutional money that's actually supplying a senior debt facility. So that money is a little cheaper than our equity money, because we basically have been splitting profit with our equity players. And that ends up being a really nice IRR for them. And so by putting
he who has the cheapest money wins.
Yeah, well, the thing of it is, so we're not doing a whole lot more on the equity side.
Trying to find, but you can find cheaper capital. That's way better for you guys.
Yeah, and then our equity investors that stay in with us actually do better, because that we still split profits with them, but now we have that lower cost money in front of them. They have to wait a little longer for their payout, but the net effect is their internal rate of return, is increased too. So it's been great. So, and then on the income side, we have an open-ended, it's a 506C as well. And it's an in perpetuitus fund, so it's not it doesn't have a beginning, a middle, and an end. It's people invest in that, and we send out a preferred return. We've never missed a preferred return. In fact, we've never even come close to clipping the trees. We raise money, and we're out deploying it to buy more cash flowing notes. And the beauty is we have we're probably about 50-50, maybe 60% is actually second liens.
Yep.
And we have enough of them now that every single month, a handful of these things pay off. And it's great because we're buying them at about anywhere from 11 to 14 or 15% cash flow on our investment, cash on our investment.
Right.
But that's as I said before, a 60 that's at a discount of what's owed. And so now we get payoffs every month. So it's a windfall that comes in.
So once you start getting those payoffs, that's the trick, is when you've been doing it long enough, in that 6 to 7 year window, all these things are maturing. People are refinancing, cashing out, or whatever they're trying to do, especially with like rates being low right now.
Yeah.
They're paying off that senior or that subordinate debt, and you guys are just getting big checks.
You get this business, man. I'm a little bit concerned. You understand.
Hey, listen, part of me, there's going to be a day where I'll probably sell everything that I have, but to get into the banking world, because I truly believe that that's probably my end game of what I do now is, when our properties mature. Right now we've got about $95 million worth of assets.
Awesome.
And we're buying more and more, but I think there's a day when Corey doesn't want to work so hard. I think notes doesn't require as much work when you build the right team, right? And
Yeah.
it's a different piece of the puzzle than it is dealing with paper and then dealing with toilets and tenants.
Yeah, no doubt about it. It's at the same time, I mean,
like you said, being on the bench is always good.
Yeah, but there are, especially when you're consumer facing, there's you really got to watch it. I mean, we're super compliance minded, but there's so many different protections for the consumer, and some of them are really good, and some of them are overkill. Some states, it's like they're almost incentivizing people to be, deadbeats. I won't name names of states.
Yeah,
in case
California, Oregon. I'll do it for you.
But it's
those
crazy.
Big blue states. Let's just put it that way.
Yeah, exactly. We've seen people file serial bankruptcies and stay in homes for we buy a lot of these loans where there hadn't been a payment in over 10 years. So anyway,
wow. But you see it all, right?
Yeah, I'm a believer in really having been a real estate guy forever. I really believe in a combination. If you own, see, the thing of it is, if you think about it theoretically, if you buy a 30-year mortgage, let's just say you buy a 30-year mortgage and it performs perfectly. Well, at the end of 30 years, you've gotten 30 years of mailbox money, super no-brainer cash flow that comes in. But at the end of 30 years, you got nothing. You've got all your money back because it's come back principal and interest. But if you own an apartment building or a single-family home, and your tenants are paying that mortgage down, at the end of 30 years, you have an asset. So kind of betraying my space, because I hear some people.
But living of both, right?
Yeah, having both is the key is, like you said, it's having a good team, whether it's hard real estate or paper, having a good team to do the heavy lifting for you and doing it right, taking the time, spending the money to do it right, and building.
I think that's the key part. What you just said is, when you really decided, you just didn't all slap everything together. You're like, hey, let's make sure we're in compliance. There's lots of regulations in that business to make sure you do it properly, and so you got to comply. And then one of my questions on that raising money thing, when you went to the 506C, do you feel like it unlocked more capital for you?
Yeah, absolutely.
Or did it take a little time? Usually when you first do your first C, it's kind of like, oh gosh, I'm not sure. I'd just like to hear your experience in that process and where you're at now with it. It seems like it's working really well.
Yeah, some of the folks that came in on the first, the Family and Friends Fund, they continued to invest with us. So they kind of seeded maybe the 506C. We don't raise money on the 506B anymore. You're not. You're really not supposed to cross pollinate.
Yep.
So we're very careful about that, making sure that we're only reaching out to accredited investors. We're vetting everybody and doing all that verifying.
Well, you have to verify too nowadays. It's not like you can even just let them come in. You've got to do the work or pay a company to do the work. Yeah. Absolutely.
So in the beginning, it was a little bit harder to get the initial investors on board, but we hired some. We hired a couple folks, and we have a capital team now. And we're at the point where we're doing online advertising, and even through podcasts, like doing this. We get people that reach out and say, "Hey, I heard you on a podcast like a year ago. Are you guys?" They look us up, and there's a ton of passive investment capital out there, and folks that don't want to own properties themselves. They don't want to work mortgages themselves. Or operate apartment buildings themselves. So they're looking for us. They're looking for guys like you and I that are committed to running a business model and doing it well. And so now it's, when you hit momentum, Corey, people, honestly, I don't think we have enough opportunities for all the investment.
That's where you go. That's where it gets to, right? And so I wanted to see how you got there, because I think I always feel money, raising capital is momentum. Yeah. In the beginning, it's like you're in the middle of the ocean and you don't even see the beach. Right?
I think a lot of people
do all the work, paddling that thing.
Exactly.
But eventually, you're riding the wave.
Right. I think a lot of it too is attitude. If you have a deal and it's a good deal, a good business model, and you're gonna treat people right, you're gonna treat your investors right, communicate with them. Honestly, they really need us.
Yes.
So I am not selling an investment to people. They have a need. They have a need for some good, secure cash flow, and I can meet that need, and I fully believe that, and I firmly believe it, and we've demonstrated it. So if you're approaching it like, hey, will you please invest in my deal? It's a mindset, and honestly, I mean, in this day and age, this sounds a little bit maybe arrogant, but the investors need us more than we need them. Meaning, there's trillions of dollars of investment capital that doesn't know what the heck to do. They're afraid of Wall Street. Look at the big drawdown.
Without a doubt. I firmly believe in what you just said there, because it is true. And I come from that world. My background is Series 766 licensed financial advisor. Wow. And the truth is, in the stock market, even the people that are taking your money, those financial advisors, paid salesmen, by the way,
right?
They don't even have any control.
Yeah.
And most people want to get off of the roller coaster.
Yep. Well,
like you said, they need people like us.
Yeah. A case in point, and this is pretty serendipitous, but I spoke at it was called an Intelligent Investors Real Estate Conference in Los Angeles, and I think it was in February. And I didn't know what I was going to be. I was going to be on a panel, and so they told me the name of the panel that you're going to be speaking on is how to build a recession-proof business. And I'm going, oh man. So my first words were, I said, first of all, I don't think anybody up here can, with integrity, say I've built a recession-proof business, because we don't know what's coming down the road or what kind of challenges we might have. I can tell you that we stress test our model, and I believe it can withstand some pretty big hits. But to say it's recession-proof, I don't know. And then I went on to explain, like, for instance, with our mortgages, they're secured by workforce housing, geographically diversified. Our notes are in 38, probably more than that, states now. And they're not high-end East Coast, West Coast houses.
Right.
So the people aren't going to leave their homes unless they are unemployed and stay unemployed. They're not looking, yep. They're not getting up in the morning and saying, hey, honey, look at Zillow, our value's down. We should probably sell this asset.
Let's not make any payments. Let's miss everything. No.
Yeah. So here we are a month later, this COVID thing hits, and I'm like, oh my goodness, I really believe and I hope that this holds true. And you know what? Our funds went like this right through COVID. We had a handful, like I said, of people that needed some help, needed some time out. We gave it to them. And at the end of the day, we've had record-breaking quarters while the stock market did this thing. Now, granted, it's back up, but like you said, you had zero control over that. What if you were somebody
roller coaster? Yes.
What if you were somebody that needed to get a hold of some of your liquidity on March 23rd?
Yep.
You know what day that was, right? That was the bottom day of the stock market, and it was like, I mean, talk about the air coming out of the balloon. So anyway,
that's usually the best day to call capital.
Yeah. Oh, yeah.
I love making those phone calls. Hey, you want to talk to me now?
Yeah.
And then they're like, hold on, I need to wait a couple more days to see what's going to happen.
Right.
Yeah. And they're hoping that it doesn't go. A lot of times they're just scared, so they sell, and then effectively they bought high, they sold low to finally get into something and to get out of the roller coaster and be consistent. Because what I believe, and you probably believe me, back me up if this is, people want consistency.
Yep.
More than yield, people want consistency
and security. Yep.
Yeah, absolutely. And security. Right.
Yeah.
And if you can offer that in this world, and I'm doing it for multifamilies. You're doing it through notes. People can win, and then it's really about the operator that's doing that investment model, just like your company, Aspen Funds. Then you're looking for track record. You're looking for history. You're looking for clues to say, these guys know what they're doing, and it's not their first rodeo.
Exactly. Yeah, no, that's exactly right. And and we got here by learning,
making the mistakes,
not necessarily
right?
How to do things wrong, but learning what can burn you. And so we're super careful, and we run we do a lot of testing of our models, and we've hired some just absolutely top-notch professionals. I mean, we pay a lot out in salaries, and we love it. It's an investment, and so it's been a wonderful. We really look at the need that we're fulfilling in terms. Twofold. Obviously, we're solving a problem and creating win-win situations on the asset side itself,
Yep.
But it's serving a need out there in the investor community where people do exactly what you said. I wouldn't tell somebody take all your money off Wall Street and out of institutional investments, although I'd be leaning that direction. But you know what? Anybody and everybody ought to have something in alternatives.
Yes.
And yet they ought to really know, it's a truly passive investment where the activity comes in is doing your due diligence on the company, on the operator, on the model.
That's it.
All that kind of thing.
Take a little bit more control in what you're investing in and who you're investing with, and then put a lot of trust in understanding that piece. And then you can still do what you're doing now. With most of Mars, they give it to a financial advisor and then they walk away. Well, but they're still on the roller coaster and they really want off. So do a little bit of due diligence in the beginning, find the right operator, find the right history and strategy. And I think most investors would be really happy with that.
Exactly. Yep. No doubt. And it's a growing thing, man. It's a snowballing deal right now.
Well, the doors are not closing and James still open. So Aspen Funds are still looking for money. So that's a great segue to say, if people are looking to find you or your fund, where should they go and find you guys at?
Yeah. So again, our investing in our funds is only for accredited investors at this point.
Yep.
And it's, we're at aspenfunds.us. So ASPENFUNDS.us. And just reach out and someone will get back in touch with you. If you have specific questions about the note space, just reach out and leave a comment and we'll have the right person get back to you. So we're very open-handed about helping people out and whatever they want to do, whether it's passive investing or whether it's getting involved in real estate. So,
all right. Thank you so much for that. I want to leave you with one kind of the last thing to say here. And I love to talk about, if looking back, you've been doing this game since 86, you said.
Yeah.
Right? That's a good amount of years, right?
It is. See this? And this didn't look like this.
And you said you lost it all twice.
Yeah.
What advice would you give for the new person coming into real estate to keep going? Because, these hurdles that we all face, yet you still persevered and won. What advice would you like to give somebody like that? That's new.
Well, okay, that's a good one. So, there's a saying out there that the best way to learn is by making mistakes. I disagree with that. I say that's the second best way to learn. The first best way to learn is from my mistakes. You learn from my mistakes. And what that comes down to is mentors. And really, if I had run into the right people that could have sat me down when I was in my 30s, the first time I was on my way to a multi-million-dollar net worth, being a small developer, using debt. And they had explained to me, some of the more conservative models of building a real estate wealth. I would have gotten it and I would have jumped into it. So honestly, surround yourself with people that are already where you want to go at some level. And you can cut a bunch of learning curve off of your life. The sad reality is most people will still choose to learn by making their own mistakes. So I could go back and reverse engineer my career and I would have done a lot better. As far as getting back on top and, when you've had the snot beat out of you, my personal story is my faith in God is what undergirds everything I do. And that's my core. That's my central. That's who I am at the core. It's just like when you're working out in the gym, they say, build your core and then work on your biceps. It's the same thing in life. I believe work on your inner person. And so my faith drives and informs what I do. So I'm just by that nature, I'm just a hopeful person. I'm an optimistic person. I believe things are supposed to work if you do it right and you learn along the way, and it's not the end of the world. You just get back up and take your skills and retool yourself a little bit and jump back in. So if you don't have that kind of a mindset, probably entrepreneurial real estate isn't the place for you. But, your audience probably is already in our world at some level. So,
Yeah, awesome. James, thank you so much for being a guest. Hey, guys, if you're listening to this podcast right now, there's lots of ways to make money in real estate, whether it's in non-performing notes, seconds, in the multifamily space, lots of ways to do it. But before you even get there, you have to decide in your mind that you are going to do it, because it will get hard, it will get difficult, and sometimes you may fail. And that's okay. But here, James just proved to us that he failed big twice, yet he's just multi-millionaire and doing great things. So guys, it's really about your choice to say, I'm going to do it and I'm not going to quit no matter what, because if you believe it, you can achieve it. That's and true. Your paradise is possible.